Hello and welcome to Switzer Investing. I'm Peter Switzer, and on tonight's show I grill Paul Rickard on the hot stock he likes right now. And I run by him the stocks that I think have upside, but the market at the moment is not really in love with. These stocks are A2M, Elmo Software and Megaport. The analysts really like these companies with pretty big upside, which I'll talk about when I have a discussion with Paul. And then we'll meet the Deputy Chair of Rex Airlines, John Sharp, who plans to stick it to Qantas and Virgin by being a viable third airline, which it always actually has been, but now it's starting to fly capital city to capital city, something they didn't do before. Then after that, CoreLogic's Tim Lawless tells us why he thinks the big boom in house prices will eventually slow down, but when. And Coolabah Capital's Ying Yi Ann Cheng gives us the inside mail on what will happen to interest rates and when it will happen. That's the show, so let's kick off with Paul Rickard of the Switzer Report. Well, now it's time to catch up with Paul Rickard of the Switzer Report. And I've asked Paul to isolate a stock he really likes right now. And I want to grill him over why he likes it and what he thinks lies ahead. And after that, I'm going to throw three stocks that I'm already invested in. And because they haven't really taken off as much as I like, I'm going to buy more of them, but I'd like to see what he thinks about those stocks as well. So Paul, thanks for joining us.
Thanks, Peter. Look, I've chosen a stock that we've liked for a little while. It's in fact for some months. It's Reliance Worldwide. It's RWC is the code. Yeah. It's in the plumbing business. It makes these fittings. The plumbing
business. A lot of people out there would say, how exciting the plumbing business is.
It's the number one in the US in terms of some of the fittings it makes that particularly go into home renovations and other sort of jobs that have been done to fix apartments. So it's got some leading brands in the States and very strong both in Europe and also Australia. So although it's an Australian company, it's more offshore than onshore.
It's a great success story when you just look at it as a business that's expanded into so many foreign markets.
Yeah, look, it had a really good run on the market after it listed. It went to something like over $6. The founders then started to sell down, then that caused a few issues because the market didn't like that. And then, of course, it went through a couple of tough years, but it's come back pretty well as the US housing market in particular has recovered. And, management's changed a little bit. And a stock that got down back in from $6 down to about $2.50, it's now up about $4.60. We've liked it for some while for our clients, Peter, and it's done pretty well the last 12 months or so.
Yeah, so some people will look at it and say, well, have I missed the boat? You know, it's had such a good rise. Obviously, you think there's more upside to this company.
Look, I do. I mean, I don't think it's on a particularly demanding multiple yet. It's priced on a multiple about 20 times this year's earnings. Yep. Now, that sounds like a lot, but given where the market is and where it's been and where some of the other competitors in this space are, I don't think 20 times is actually that demanding a multiple.
Not with interest rates as low as they are.
Not with interest rates the way they are. And, it started this year. It reported well in February. It said that sales for the first 6 weeks of this half year up about 14% in constant currency terms. So still very strong sales. We know that the home market is pretty strong in the States as it is in Australia. It's not just new homes, it's more about people renovating and doing things. And then, of course, if you have a really strong primary market, new sales market, that actually encourages people to renovate and do all those sort of things. And with the stimulus checks going around, they've suddenly got money to do it. So that all goes well, I think, for the company. As I said, the multiple's not particularly demanding at 20 times. It was back at $6 in 2018. I don't think it can, I'm not saying to get back to 6, but I think you can see another 50, 60 cents, at least 10% from here. Analysts have got a target price of $4.86 on consensus, but a range a high of $5.50 down to $4.40. So the analysts think there's more in it. I think the multiple's pretty good. Look at that chart. It's on the uptrend.
It's going up and down sideways, but you can see there's an uptrend there. If you go back to where the first pull out around August of 2020, well, if you keep following your eye along, that's on a rising trend, even though there's ups and downs. So I like the company. You're right, Paul. And I also think because the boom in the US is going to be strong. Biden's spending a lot. He's doing infrastructure spending. That creates jobs. It creates the whole, expansion of residential properties around those infrastructure projects and whatever. I just think you're absolutely right. This is a good company. It might not shoot the lights out. We were better off buying it in August or even the depths of March. but certainly I think you picked up a good
Yeah,
company.
I guess just to give you the risk side, a couple of risks. One is, of course, raw materials. I mean, if copper prices keep increasing, that has a bit of an impact. So there's that's probably why you're not seeing it tear off, because the people are worried about input prices. And again, of course, it's it's not one of these companies where a lot of the sales are coming out of the States, and so if the Aussie dollar keeps increasing, as we think it will, that's just going to make it harder. But I think it's a pretty well-run business. It's good actually to sell it. The founders have largely got out of the company. It's got a new management team. I think it's doing pretty well in all of its key markets.
Yeah, great. Okay, that's yours. Now I've come up with three, Paul, and they're three stocks that I'm already invested in. I invested in them knowing that it was going to take time for them to come back. I liked the idea that the market had sold them off, and I thought, well, it's a good time to buy. And I guess my question is, is it still worth believing in these three companies? So let me run through them first of all. One is I know you've got a view on, and that's A2 Milk. Now, as I say, I probably bought around 8 or 9. It's down around near $7 or something now, and I want to buy more because I think it's going to eventually come good. But I realise that it's going to rely on the Chinese to be playing a much better game. International travel has to improve because the Chinese tourists took a hell of a lot of that stuff back. But I always keep coming back to something you always talk about, and that is it's good to buy the best of breed in a particular industry. And this is what it is.
I think it is the best of breed with the best brand name. And that has value, Peter. Now, I think the market's still probably expecting. One of the problems with A2 Milk is that clearly, management's been overconfident. We've now had 3 downgrades, all in very short succession. Well, we all understand the reasons. Obviously, obviously the closure of borders, the Chinese Daigou haven't been able to travel, so there's that, and also there's more competition occurring in China from local brands. But management were just too confident or didn't want to tell the market the whole story. We've had 3 downgrades and the market still feels there could be another one coming, right? Yeah. So that's why the price hasn't been going up.
So that actually creates opportunity if a piece of bad news doesn't come. That is always possible.
So I think it's sort of starting to bottom a little bit. I mean, there was some news.
Maybe we can see the chart there and actually show us.
One of the major brokers came out today with a research report just pointing to the fact that the local Chinese brands are picking up share. And so it's sort of saying that both A2 Milk and Bubs will find life harder going forward because the margins will come down because they'll have to come down in price to respond a little bit to the local manufacturers. But look, I think it's a good company. I'm looking to buy. I just sort of watching the price at the moment. And I think there's still time because I think the market is still worried about this fourth
and I'm
piece
kind
of
of
bad
thinking
news.
I might have to wait a year, but if I buy at $7 or something like that, so give us the 5 years and see, this is where it was. Yeah. It was a $20 stock. And I'm thinking to myself, well, if I buy at 7 and it only gets to 10, or buy at 8 maybe and it gets to 12, there's 50% on a company that was a $20 stock company. So it seems to me if I'm prepared to wait, there's going to be a payoff.
And it does tell you, I mean, I always struggle why I was at $20, but I have to say I liked it at $14 and $15 and I liked it again most of the way down. I've now understood that it's I think you've got to have management hasn't always been as straight as they need to in the last part, and that just shows you how quickly, a market darling can become a marking horror story, and the market's sort of saying, well, we think there's more bad news. So that's why it's not going up. So lots of retail investors have been buying it. The instos are still unloading it. I think it's got value, Peter, and I'm sort of almost there. I just don't know whether I need to do it tomorrow or I can wait a little bit longer, but I'm not too far behind you.
Happily, it is up 2.39% today.
Yep.
Let's go to the next one. There's another one, and I'm invested in this one. I'm going to buy more. And that's ELO, and that's Elmo software. I just think it's a good company. If you look at the 1 year chart, it's been as high as 8 and it's now around 5.13. You can see it has ups and downs. It wasn't all that long ago the market really liked it and the share price was around $7 or so. It seems to be...
And nothing's really changed except that the market has sort of said, well, okay, we don't like some tech companies as much as we used to, although Almost Software would say it's not really a tech company, but it gets caught up in that sort of brush, right?
Yeah, that's right. And I think that's the important point. I think Elmo is a company that's going to benefit when normal businesses practices are restored. And in Australia, we're getting close, but we know office workers aren't coming back to offices and all that sort of stuff. So there's probably some time, but I must admit, every piece of news I get about this, and I've interviewed the CEO a couple of times, he hasn't made me feel nervous about being invested.
And if you believe, just think about at the macro level what's happening on employment, Peter, that's got to be good for it. It's
the
not
payroll.
It's the payroll, but also if we really have record job advertisements, employers are going to have to start to worry about their staff again. Yeah. So things like training and development and all those other things that you actually need this software for become important, because
it's HR without having an HR person.
Because it's really hard to not just attract staff, but actually retain good staff, right? And if the employment market is hot, which, if you look at the data, record number of job advertisements in February in Australia. We saw the ABS data in terms of new job positions created last month. We all thought that was a bit of a joke. We saw the data in the US on the weekend about huge there. We could have a really hot employment market, in which case, companies are going to have to invest again. Particularly, this is designed for small companies, right? Small and medium. It's not for the big companies.
Who have their own HR staff.
But who have a whole HR team of HR people. But this is really for small and middle-sized companies. These sort of bits of software and the packages that they sell become important. So I think the market has yet to sort of look at the macro. The macro's got to be supporting this company now.
And I think you are right. They see it more as a tech company that allegedly benefited from the stay-at-home period, but the management say, no, we actually didn't do as well as we would have liked, but we need business normal to actually materialise the sort of profits and revenue you'd expect. Now, are you invested in the ELO?
I'm invested around these levels. Okay. I invested about a month ago. It hasn't really done a lot the last month. It's been about 525 and 495. But I'm a believer in the company, Peter, and I think this is one to put in the portfolio and be patient. I'm very impressed with management, and I like what I see.
Okay, let's go to the next one, and this one's called Megaport.
You're out with a thrill seekers on Megaport, Peter.
Yeah, but it's had a nice rise recently. You can see it was up there around $17, and that was after the coronavirus crash. All right, so this is a company that I am invested in, Paul, but I don't think you're invested in Megaport. No. Okay, now the reason why I like this company is I interviewed Bevan Slattery, the guy who's one of the co-founders, and he was the guy who started NextDC and a whole lot of other really interesting tech companies. And he kind of explained to me that the way this company works is, take the VRC around Melbourne Cup time, all of a sudden its website's going to be hit by millions and millions of people who want to know what's going on, and that they don't really need a website that can carry that kind of traffic all the time. So that kind of business would go to Megaport and actually just get a temporary build-up of their website capacity. And he said, this is the sort of thing that Megaport got into before most other companies. He says that the company's got a head advantage or a head start on most other companies. And it just seemed to me it was a business that's going to do really well. And I want to throw one other thing.
So basically providing instant capacity in terms of virtual servers and things to these companies. Yeah, it's like an instant cloud almost, right?
I wasn't sure whether this is a maturing industry or not, but I then did a presentation recently where the guys from WCM, that fund manager, one of those guys presented, and he was talking about how they invest in a lot of tech companies that are in the digital space. But this is the thing that quite shocked me. I hadn't thought of it in this terms. He said, digitisation is only in its infancy. So if digitisation's in its infancy, a company like Megaport is really well established to benefit when the whole thing gets bigger and bigger. What do you think, Paul?
Look, I agree with the thesis, and that's why a lot of investors really like sort of cloud-based businesses because they just know they're going to grow, right? I mean, if you believe that one of the big mega trends is digitisation, it's got to be good for cloud business. It's got to be good for things like artificial intelligence. It's got to be good for things businesses that own data centres like NextDC, and people that can provide the capacity like Megaport. So, look, I don't know enough about the company to really comment, Peter. Apart from, Bevan Slattery is a pretty impressive character and a pretty astute tech investor. That chart doesn't look too bad in terms of where it's at, and the recent rise is impressive. One thing that has been a standout the last couple of weeks is that, we were talking about this the other day, is that the worst performing sector in the March quarter was technology. That's on the ASX. But that finished about a week ago, right?
Yeah,
and
coming back to it.
And pretty well in the last 3 or 4 days, the best performing sector has been technology. What's been interesting is the best tech stocks have gone up, all right? So it's your Afterpays, it's your Zeros, it's your next DCs. Actually, what I describe as blue chip might be the wrong word, but you know what I mean?
Yeah.
People buy the best, right?
Yeah.
When they want to buy. And we've been saying for a while, technology, there were some opportunities in tech simply because of this whole rotation stuff. Buy the best, not the worst. They're the ones that first. And that's a good example because that's a pretty impressive rise for Megaport over the last few days.
Yeah, okay. So before we go, I'd like just to put on screen those 3 companies I've looked at, and I'll tell you what the analysts are saying about these companies right now. So on the screen, have a look. You've got my first pick, A2 Milk. The analysts think 19% upside. Elmo, 84% upside. Now, I can't walk away. There ain't one analyst that looks at it, but that analyst would do more analysis on that company than any of us even here. So that makes me interested. And Megaport up 20.6%. So as you see, the professionals who assess these companies like these 3 companies. I'm invested. I'm going to put a little bit more in there as well because I do think over the next 6 to 12 months I should see a result. So, Paul, we should actually throw Reliance in there as well. You actually looked it up.
Yeah, RWC, analysts thinking about 5 or 6%. Not as much as yours, Peter, but I think probably just a little more blue chippy.
Yeah. Reliance
than
is,
at least a couple of those.
Reliance is a very reliable company.
Yeah.
So that's Paul Rickard from the Switzer Report. Coming up next, we'll be talking to the Deputy Chair of Rex, John Sharp, former Aviation Minister in the Howard government, now Deputy Chair at Rex. And he's going to tell us how Rex plans to stick it to Qantas and Virgin. Well, before going to John, last week I interviewed him for my podcast, Learning from Legends. And some of the answers he gave to me I thought were really relevant for people who invest in the stock market. So I've taken out through my questions and through the answers for your consideration, just in case you were thinking about investing in an airline like Rex. So John, the history of Australian airlines has been that when there's effectively a third player in the market, one goes. How has Rex survived, given the fact that Qantas must have eyed you off and thought, we'd rather these guys not be here. Let's play some hardball with these guys and see if we can rattle them and get them out of the market. How have you survived?
Well, we've survived, Peter, by having low costs. I mean, we've started as a family business, the Hazelin and Kendall families. That culture runs on to this day. And like all family-owned businesses, it's your money that somebody's spending, and so you take a keen interest in how it's spent. We don't pay big wages. Our senior people are paid to the top of them are paid in the sort of the higher $200,000 a year bracket. For 10 years, we didn't pay a dividend, and we kept all of the profits, and we've funded our capital expenditure out of cash flow when we built the company up to make it stronger financially. And, we've survived as a consequence of that. So when we arrived at the pandemic, the COVID pandemic, we had no debt. We were always profitable. In fact, it's interesting, Peter, Rex has made, in the last 12 years, Rex has made more money than Qantas, more profit than Qantas. I mean, Qantas has made a loss, accumulated loss of now about 1.75 billion. And Rex has made about 300 million during that period of years. So it's a really interesting comparison. People think Qantas is the biggest and the strongest and the best, but in fact we've made more money than they have, and we're in a far better position financially than they are, with no debt and low costs. And so yes, Qantas Qantas has always been the biggest. It's the oldest airline in Australia. We're the second oldest. They're the oldest airline in Australia. They're the biggest. They've always used their weight, their muscle, to bully other airlines in the marketplace to get what they want. And they're a very tough, very aggressive competitor. And Qantas has gone into some of our regional markets, and in the last few months, and they've started to compete with us on those markets. And there's no way they can make a profit on those routes. I mean, some of those routes, like Sydney to Cooma, we have 6,000 passengers a year. You divide it by two with two operators on it. Qantas is going to go on that route. There's only 3,000. If you divide it in half, there's only 3,000 passengers a year. You can't make money on a route like that. Never can, never will. They're doing it solely to punish Rex, to try and weaken us and tell us, look at what we can do to you. We can do even more if you don't wave the white flag and give up. So, that's the way they operate. They always have. We knew they'd do that, but we're in a good position. It's when you've got very low costs like we do, we can withstand a lot of competition.
Okay, so you're saying because you're now flying the routes capital city to capital city, that it's a bit like Robert De Niro. If you're going to mess with me, well, I'm going to mess with you. Is that what's going on at the moment?
That's exactly what's going on. It's funny. I mean, Alan Joyce is a fantastic fellow and like him very much, but he's a really strong, competitive, aggressive, competitor. And
it's unusual for an Irishman to be like that, isn't it?
Very. Most Irishmen put him in a pub on a Friday night, they'll have a fight. So Alan is very much of that sort of very competitive mould. But these routes that we're moving into, Sydney Melbourne, for example, people don't realise that Sydney Melbourne is the second busiest airline route in the world, 10.6 million passengers a year. The busiest one, Peter, is New York to London. New York to London, the busiest route in the world, has 13 airlines that offer a service between the two destinations. And the second biggest airline route in the world, Sydney to Melbourne, has two, Qantas and Virgin. And it's argued that the Sydney to Melbourne airline route is the most profitable route in the world. So, there's room for more operators on those sorts of routes, which is where Rex intends to operate.
I'm thinking about what you're doing as a traveller, a pretty excessive traveller, I got to say, but also, I'm a person who watches the stock market really closely. Do you think the market understands the potential of what your guys are going to be doing?
No, I don't think the market really understands. I suppose it's our own fault because we don't put a lot of effort into trying to sell the sizzle with our sausage, so to speak. We don't dress things up. We don't say things for the purposes of trying to boost our share price. We've never done that in the past, and we're not going to change in that regard. But we are. If you look at Virgin, Bain Capital paid $3.5 billion for Virgin, and what they bought was half of what Virgin used to be. They bought a brand and they bought a lot of high costs and they had a lot of problems to resolve. Rex can easily be the size of Virgin, in fact, bigger, within a few years' time. And, our market capital on that basis would go up by 10 or 12 times.
Okay, so let's focus on the big changes. And just in a nutshell, what are the big changes that you're bringing to market, which ultimately should have a big impact on your revenue? Hopefully it has a big impact on your profit as well, despite the fact that you are going to have competition. So what are the big changes to Rex that could actually not only excite the travellers of Australia, but also potentially the stock market?
Well, I think what Rex is doing, and the big changes, is that we are expanding into the domestic market. We're expanding into a market that instead of having 1.4 million passengers a year, will have many multiples of that. We'll grow our domestic business as time goes by. We'll go from having revenues in the $300 million a year category up to in excess of $1 billion over time, and we will be doing that differently. We'll be expanding our regional network during that period as well, because Virgin has left a number of regional routes. For example, this week we've started flying between Coffs Harbour and Sydney and Port Macquarie and Sydney, and we hope to fly in West Australia between Perth and Geraldton before too much longer. They're routes that Virgin has abandoned, and we're so expanding into those. They're quite big routes. We're expanding into the Canberra market. Sydney-Canberra's 930,000 passengers a year pre-COVID. Sydney-Melbourne's 1.2 million passengers a year pre-COVID. We are starting to grow that part of our business, and we're doing it from a low cost base. So, we potentially, once we get established, we potentially will be a very strong business.
And that was John Sharp, the Deputy Chair of REX. And now I'm going to be talking to Tim Lawless from CoreLogic about these unbelievable house price rises. Well, at a time when house prices seem to be going through the roof, one man who have a pretty good perspective on it is Tim Lawless from CoreLogic. Tim, thanks for joining us.
Hi, Peter. Always a pleasure.
Okay, I think is it the Sydney house prices or is it the national house prices have risen at the fastest rate in 33 years?
Yeah, well, both have.
Both.
But yeah, it's quite a phenomenal story. We are seeing housing markets or housing values rising at record-breaking levels, virtually at least since the late 90s, or the late 80s. Sydney housing values were up nearly 4% in the space of 1 month alone. So it gives you a bit of an idea of the heat that's in the marketplace and just how strong selling conditions are driving such rapid capital gains.
Mm. So obviously, because you're so young, Tim, you've never worked and seen something like this before, or have you seen something like this before in maybe a separate market? I do remember Perth went through a unbelievable price rise a few years back, but is this something really unusual on a national level?
Well, it is absolutely. So it's not, it's not a frequent occurrence. You see housing values rising this quickly, but what's even more unique is just how synchronized this upswing is. We're seeing housing values rising rapidly pretty much everywhere. The weakest performer over the month, at least across the capitals, was Adelaide with a growth rate of 1.5% in a month, which in itself is quite extreme. So the last time we saw housing markets moving in this synchronized fashion where every region across the country was rising in value was just after the GFC, which has some similarities, I guess, in the sense that there was a lot of stimulus on offer at that stage. Interest rates had come down as well. But what's happened over previous times where we're seeing housing markets rising this quickly before, there was always something to slow the market down, be it either rising interest rates or removal of stimulus or a weakening economy. This time around, it looks more and more likely that, well, we're not expecting rates to rise anytime soon, at least short-term rates. We're not expecting an economic slowdown. Looks like there's plenty of momentum there. We're not expecting any sort of other black swans coming out, hopefully, although that in the nature of it, we can't see that. So what's more likely is we'll see this housing growth trend being slowed by a tightening of credit, which of course is looking more and more likely, probably more now a case of when, not if. And that's probably the uncertainty is when we might start to see any sort of tightening in the credit sector that could start to slow down the housing market.
Tim, you have been around long enough to, I know you have seen a lot of Reserve Bank governors make comments about the state of our housing market. Are you surprised that Dr. Phil Lowe seems to be so relaxed about house price movements at the moment?
No, not really. If you look at the statements coming from the RBA, they've been very clear. They are watching housing markets quite closely. But I suppose to the RBA's mandate, housing isn't part of their mandate, nor is it part of APRA's. Financial stability is, obviously. So I think the RBA is right in saying that it's not really their job to wade into the economy and slow the housing market down, but it is their job, particularly the Council of Financial Regulators, to be watching credit flows. And that's what they've been saying repeatedly. Any sign of a material worsening in lending standards will probably be the catalyst for any new macroprudential policies. We know when the December data was released a few weeks back from APRA, it did show that lending standards had slipped a little bit. There was a rise in interest-only lending. There was a rise in high debt-to-income ratio lending. There was a rise in higher LVR lending as well, but probably not enough to trigger any sort of reaction just yet. But my guess is those statistics will be watched quite closely. And if we see a further blowout in those metrics, along with rapidly rising housing prices, then almost undoubtedly we'll start to see some credit tightening happen.
Now, I want you to show some courage here, Tim. I know you're a very careful and respectful man, but do you think that the Reserve Bank and maybe even the banks have been a little surprised at how fast we have recovered. And as a consequence, when you're factoring unbelievably low interest rates and the quickness of this recovery, it just makes total sense that house prices should rise so quickly, given the fact there's a supply problem as well.
Well, I think at the heart of this housing price surge in values is exactly what you're asking. It's the fact that we have seen the economy recovering much faster than what any of the forecasts were suggesting. Even mainstream economic forecasts outside of the RBA or Treasury hadn't predicted an economic rebound that was this quick. So that's really behind what's inflated consumer spirits. We're seeing consumer sentiment well and truly above COVID levels, and that's obviously stoking demand at a time when housing supply remains really low. And by housing supply, I simply mean the number of homes that are advertised for sale. We are seeing more homes being built, of course. So I think really at the heart of this growth in housing values is this disconnection between the number of homes that are available to purchase and the surge in buying numbers we've seen. In fact, to put it into numbers, we've seen about a 25% lift in buyer activity and about a 25% fall in the number of homes that are available for sale. And it's that shortage of supply against really high demand, which is creating this urgency, call it FOMO or whatever you want, but it's that sense of urgency that's really creating this upwards pressure in housing prices.
So why is there such a low supply of housing? I would throw in one possibility as a question in a sense. Are a lot of people who might own a home keeping them and renting them out and buying another one?
It's hard to say. So if you look at the listing numbers, we're now seeing the number of new listings coming in the marketplace is higher than a year ago. It's higher than 2019. In fact, it's a little bit above the 5-year average. So we're starting to see vendors taking advantage of the really strong selling conditions. There's more stock coming on the market, but what's keeping overall advertised supply low is this really rapid rate of absorption. You look at a ratio of, say, sale numbers to new listings, it's tracking around 1.1, 1.2, which means for every new listing that comes on the market, there's more than one home being sold. So that's what's keeping overall stock levels down and creating this urgency. To the second point of your question, is this more about people renting a home or keeping their old home and buying another one? Yeah, maybe there's a little bit of that. Maybe another factor that's coming into it is we are anecdotally at least hearing a lot more properties that are selling without an advertising campaign. They're selling off market. So no doubt that's probably skewing or maybe dragging the overall listing numbers down a little bit if we're not seeing them being advertised. But I think another factor that's probably really important is what we can see in some of the building approvals data is there has been a bit of a renovation boom at the same time as a housing boom. And we're probably seeing more people willing to stay put rather than upgrade or downsize. They're renovating, and maybe that's a little bit of fear that when the market's moving so quickly, they don't want to sell and then be locked out of the marketplace down the track. Or maybe through COVID, they're much more willing to stay put and just upgrade their own premises and maybe take advantage of the home builders grant where you can get, you could previously get a benefit from a material renovation.
Yeah, I think I might have to call it the Scott Cam, the block problem. Everyone's watching Scott and renovating their homes to increase the real value of their property. Yeah,
well, my tip there would be don't try to pull a Scott Cam yourself. Every time I try to renovate something, I end up paying somebody to come in and fix what I tried to do myself, and it costs me double the amount. So
okay, use your crystal ball to tell us what you think is going to happen in this market.
So we are expecting prices to continue rising, but not at the same pace as what we're seeing currently. You wouldn't expect housing values could possibly continue to rise this quickly at a time when incomes aren't really doing all that much. So particularly now that we've seen a lot of the fiscal support winding out, it makes sense that demand side that I've been talking about is likely to start tapering, probably more due to first home buyers becoming less active. We know that first home buyers will be more sensitive to affordability constraints. There'll also be less stimulus there for first home buyers. Take Victoria as a good example. We see the stamp duty discounts will expire through the second half of the year. There's probably going to be this pull forward of demand that we've already seen will have a downside to it as well. So I'm expecting we will see demand dropping off through the second half of the year, supply probably rising as well. That should be enough, along with affordability constraints, to start slowing the market down a little. And then if I'm right, and we do start to see some credit constraints coming into the marketplace, I think if we do see that, they'll be more aimed at keeping household debt levels low, so maybe firm limits on LVRs or debt to income ratios. But any sort of credit intervention you'd have to expect is going to dampen the marketplace as well, along with those affordability constraints that are more organic.
Okay.
So yeah, rising prices through 2021, probably well into 2022. But personally, I think we're probably moving through the peak rate of growth at the moment.
One last one. Have apartments been left behind? Like particularly in Sydney, there were fears about apartment blocks falling over. Then you had the aluminium shield problems and all those sorts of things. Have lots of buyers avoided apartments and chased homes, pushing up home prices at a faster rate than apartments? And therefore, could there then be a shift into the apartments because there's potential value there?
There's a few things happening in the apartment market. I think it's pretty clear that there's been a preference shift away from anything that's higher density through the pandemic, which I guess is normal. We have seen houses well and truly outperforming apartments in terms of value growth, but also in terms of just simply market activity. You know, we're seeing house sales tracking around 17% above the 5-year average. Unit sales are still a little bit below the 5 average in terms of overall number of sales. And to your point, there's also those legacies in the unit sector of oversupply in some inner city precincts, of flammable cladding, remediation costs, of construction quality. So I think all those things have added up to an underperformance in the unit sector, but we are still seeing unit prices rising. They're just simply underperforming. Even in some of the really hard hit rental markets like Melbourne CBD and Docklands and South Bank, inner city Sydney, where rents have fallen, 13 to, in some cases, 25%, like in Melbourne CBD. Even in those inner city high-rise precincts, we haven't seen apartment values falling, at least just yet. They're up mildly. Maybe this is a symptom of mortgage deferrals holding distressed stock off the marketplace. So we'll get a little bit more of an insight about that over the coming months. But yet those inner city apartment precincts have been amazingly resilient despite this significant downwards pressure on rents. Values seem to be holding relatively firm.
Great stuff. Thanks for joining us, mate. And let's hope you're right. Well, joining me now is Ying Yi Ann Cheng from Coolabah Capital, and we want to really understand what is the latest outlook on things like interest rates, because there's a sort of changing mood at the moment, but I wonder whether the experts at Coolabah are changing their attitude towards interest rates. Good to see you, Ying Yi.
Good to see you again, Peter.
All right, so I don't expect you to change your mind, but there is a bit of an argument going on out there that maybe interest rates will rise quicker than people expect. What are you guys thinking about those arguments?
Well, the market is definitely sort of pricing that in. So, a lot of the moves that we've seen in bond markets is really about the long end. So we're talking about that 10-year part of the curve. So we've seen 10-year yields largely driven out of the US, really spike up. So earlier this week, they got to 1.77%, which is quite, dramatic in the scheme of things. And it doesn't really look like this concern or these market expectations are abating. However, you need to remember that we're talking about the 10-year part of the curve. So this is the market expectation in 10 years' time. So, right now, the market is looking at all the stimulus that's taking place. So in particular, this Biden stimulus package, what they're doing around infrastructure, etc. And so, they're looking at that and they see this as massively, stimulatory and will cause inflation down the track. However, what we've seen, central banks commit to, with whether it's, the ECB, offshore and the Fed, but also in particular the RBA, the way that the RBA is communicated is that they're very committed to lower rates, at least in the near term. So we're talking over the next couple of years. So rates aren't going to be running away anywhere in the next couple of years. Down the track, that might be a bit of a different story. But obviously, markets are incredibly intelligent and smart, and they're always thinking ahead.
Yeah, but it seems to me, Ying Yi, that even the view on 10 years, like it's not even 2% in 10 years' time. It's probably going to be 4 or 5% in 10 years' time. If you look at the kind of boom that's probably going to happen with all this spending going on. So,
yeah, quite possibly. Look,
yeah.
I mean, we could easily get to 2 or 2.5%, down the track. So the risk for the inflation risk for a lot of fixed income portfolios is very real. So, we have always had the philosophy that we don't want any fixed rate risk in our portfolio. For that very reason, is that when inflation does come and you have, fixed rate bonds or fixed rate risks in your portfolio, that is quite detrimental. So, it's no different to you deciding to fix your mortgage or not, right? If you believe that rates are going to be higher in the future, you probably want to fix your rate now. Yeah. However, when you're a bondholder, i.e. you're the lender, you sit on the other side. So you definitely don't want people. So you actually, if you fix the rate and lend to someone at a lower rate when you can actually get compensated at a high rate in the future, you actually lose out. So it's the opposite. Yeah.
And that's why you guys chase floating rates rather than fixed.
Well, this is why we decide to hedge all of our portfolios and we have no fixed rate risk. So it's all 100% floating rate. It's not to stop us from investing in fixed rate bonds. However, when we do invest in fixed rate bonds, we just take out that fixed rate risk. We hedge it.
Okay, so your colleague Chris Joy in the AFR has been looking at the house price boom, and he's very positive that there's going to be the price is going to rise. But what's his attitude towards APRA? Does he think APRA is going to eventually come in and restrict the amount of lending that banks are prepared to make to certain sort of borrowers out there?
Yeah, I mean, look, it's lending at the moment isn't really a concern. And if you look at house prices, we're only still very much back to, pre-COVID levels. And, in terms of Melbourne, where they haven't, house prices haven't actually changed dramatically, say, since 2017. Yeah. And so, sure, house prices have been recovering, but we're not in a bubble. If we do get to a point where we consider it to be a bubble, then there is definitely nothing that will stop APRA from stepping in and reintroducing those macro-prudential sort of measures. And if anything, that's probably the preference, that APRA introduces macro-pru rather than the RBA hiking rates necessarily, because some people have been talking about, RBA doing quantitative easing. So RBA doing quantitative easing involves them going out and buying Commonwealth government bonds and state government bonds. That shouldn't affect house prices. So, they want to keep the cost of borrowing down for the government so the government can create jobs, etc. So APRA macro-pru, if it was a very targeted measure for the housing market, if it does start, heating up excessively, would probably be the most preferred tool, if anything.
Yeah. Okay. Now, one of the reasons why I got you guys to manage the bond fund that is out there now, known as the Switzer High Yield Fund, is that I do think you guys are some of the smartest people playing in the interest rate and the bond market space. And a lot of people are saying to me that they think in a not too distant future, these fixed rate home loans with a 1 on the handle, like 1.9 or whatever, will probably start to rise. What's your feeling about fixed interest rates in the home loan market?
I mean, obviously, can never give financial advice, but I suspect they will rise before the next, probably, in the near to medium term even. Yeah. And the reason why is because, firstly, the banks have been able to extend very favorable rates on fixed rate mortgages because they have had access to the term funding facility. So the RBA introduced the term funding facility in the middle of COVID last year in March, and they said that the banks would be able to borrow out to 3 years at 0.25%.
Yeah.
And then later on in the year, they lowered that same rate from 0.25% to 0.1% in line with, you know, the lowering of the cash rate. So, however, because the banks they've been awash with liquidity. They haven't needed to really access this term funding facility that much. So, you know, given the banks are not the ones that are struggling at the moment, you know, the RBA has said that they are not going to extend this term funding facility and that they're going to just allow this to roll off, you know, later this year. In which case, that means that if the banks aren't able to access the RBA's term funding facility after, you know, later this year, this means that they, you know, will have to go out and, you know, effectively borrow at, you know, the market rate rather than that, you know, special discounted 0.1% rate.
Yeah.
And, you know, we should expect those fixed rates to move higher. So yeah, that's definitely a very conceivable, you know, premise that you pose there.
Okay. Now, as you said, you're not giving financial advice, but let me set up a scenario, right? Your favorite cousin comes to you and says, Ying Yi, you're an expert on this, and we want to buy a house and we're not sure whether we should do variable or fixed. And I'm kind of thinking these fixed rates look really good. Should I do it for the longest possible time, or should I do it for the shortest possible time? What would you say? It's not only because it's your favorite cousin that you would give you your best possible financial education view as opposed to your advice.
Well, I can give you a personal anecdote because I have just bought an investment property myself, and I have fixed for the longest possible period. Personally, you know, but again, that's not financial advice. That's
of course it's not.
Opinion.
No, it's just brilliant financial education.
Yeah.
Ying Yi, thanks for joining us on the program. We'll talk to you in a couple of weeks' time.
Thank you so much, Peter.